This recording is going to look at marginal costing, which is a technique that is used for short-term decision making. Within marginal costing, we classify costs into two categories, variable and fixed. And when we talk about the marginal cost of a product, we are talking about the variable costs, with the variable costs of a product being direct material, direct labour, and the variable overheads. The fixed costs are treated as a period cost. This means that they are not absorbed into the cost of the product. Now, we tend to use marginal costing for short-term decision making, and its emphasis is on short-term because we tend to look at our decisions based around the variable cost of the products, as in the short term our fixed costs will remain the same. They're unlikely to change. In the long term, remember, your fixed costs can change. So we can think of the marginal cost of a product as being the cost of one unit, which, if we did not make that unit, the marginal cost would not be incurred. And for every additional unit that we produce, then that marginal cost would increase. So the marginal cost is the variable cost of our product. Another term that you need to be familiar with in marginal costing is the term contribution. Contribution is the difference between the sales revenue and the variable cost. What we mean by contribution is that that difference between the sales revenue and the variable cost will contribute towards the fixed costs and eventually making a profit. Now, you will see that we can calculate contribution per unit, or we can also calculate a total contribution for a period of time. For example, the total contribution for a month or a quarter or for a year. So to summarise, sales minus our variable cost of sales, so in other words the direct material, the direct labour, variable overheads, gives us contribution. And it is our total contribution figure that we will then deduct our fixed costs from to give a profit. So if we have a look at an example that highlights this. So we have a company that produces 3 products, and the following operating statement has been produced, which is based on actual results. So we have the sales revenue for 3 products and in total. We have the production overheads for the 3 products and in total. We then have a rent overhead for the 3 products and in total. And finally, we have the net profit or loss, which has been arrived at by taking the sales revenues minus all the overheads. Further information that we're given is that the production overheads are 2/3 variable and 1/3 fixed. The rent is a fixed cost, and we're told there are no opening or closing stocks. Now, we're required to convert the above information into a marginal costing format, and we're also told that the directors consider that as product X shows a loss, it should be dropped. Advise the directors on the action they should take. Right, so the first thing we need to do is have a look at our statement. Now it's telling us to convert it into a marginal costing format. We know that it is not currently in a marginal costing format because it does not show any contribution. And in marginal costing, we have the term contribution. So the format that we need to get this into is to show the sales, then minus the variable costs. That will give us a contribution, and then we will minus the fixed costs, and that will give us the profit. So we need to know what our variable and fixed costs are. We've been told our production overheads are 2/3 variable and 1/3 fixed. So if we look at the production overhead figure, for product X, we have £36,000. So 2/3 of that is going to be 24,000, and 1/3 of it is 12,000. With product Y, our production overheads are 38,000. So 2/3 of 38,000 works out to 25,333. And 1/3 of 38,000 works out to 12,667. Now if we look at product Z, production overheads are 34,000. So 2/3 of 34,000 works out to be 22,667. And 1/3 of 34,000 works out to be 11,333. So the 2/3 is the variable part. And the 1/3 is the fixed. So we can now begin to construct our marginal costing statement. We're going to start with the sales figure, and we're going to look at each product and in total. So our sales, we've got 32,000 for product X, 50,000 for product Y, 45,000 for product Z. Adding them all together means our total sales 127,000. Now we're going to take away our variable costs, and that will give us contribution. So we've worked out the variable costs already. That's these figures up here. So we're just going to put those into our marginal costing statement. So 24,000, 25,333, 22,667. And in total, that comes to 72,000. So remember, we're deducting our variable costs to give us the contribution. So sales minus the variable cost for product X is £8,000. For product Y, the sales figure, 50,000 minus the variable costs, gives us a contribution of 24,667. And finally, product Z, 45,000 minus the variable costs, 22,667, gives us a contribution of 22,333. Okay, so we've done sales minus the variable costs. And if we just do the total column, sales minus the variable costs of 72,000 gives us a contribution of 55,000. Now it's always worth doing a double check here that your figures are correct. Add up your individual contributions from X, Y and Z, and that should come to 55,000. So that's the first part of the of the marginal cost statement. Sales minus variable costs equals contribution. Contribution minus fixed costs equals profit. Now, a very important point here is that we take the fixed costs from the total contribution. In marginal costing, we do not take the fixed costs from the individual products. They are treated as a period cost, which means that we just take the total fixed cost for the period and deduct them from our total contribution for the period. So we need to know what our fixed costs are. So if we look back at our calculation with our production overheads, we had fixed costs of 12,000 plus 12,667 plus 11,333. So that adds up to £36,000. So we've just added those three figures together. Now we also have another fixed cost. Rent is a fixed cost. So the rent overhead is £3,000. So we have £36,000 here of production overheads that are fixed. We have another £3,000 of rent. That tells us that our total fixed costs are £39,000. Now remember, fixed costs are deducted from our total contribution. Our total contribution is £55,000. We will deduct the fixed costs of £39,000 and we have a profit figure of £16,000. So you will note that this profit figure is exactly the same as we were showing before, but the difference is in the layout of our statement. So if we look at the original statement, our overheads were apportioned across our products. That's because the original statement was in an absorption costing format, and in absorption costing we do apportion overheads and then we have to work out an overhead absorption rate and we absorb our overheads. In marginal costing we do not do that. Instead we treat our overheads, which are our fixed costs, as a period cost, deduct them from the total contribution. Do not deduct fixed costs from individual contributions. So that is a really important point. Always deduct your fixed costs from your total contribution. So there's our marginal costing statement. Now the second thing we were asked to do is to advise the directors on the action that they should take with regard to product X. On the original statement, product X was showing a profit. Product X was showing a loss of £5,000, and therefore the directors were arguing that it should be dropped. However, if we look at our marginal costing statement, product X is making a contribution of £8,000. Now, if we drop product X, we will no longer make that £8,000 contribution. So by dropping product X, if I just rewrite this statement, sales minus the variable costs will give us the contribution. Product X we're dropping. There'll be no sales, there'll be no variable costs, there'll be no contribution. Product Y, 50,000 sales minus the variable costs, we've got contribution. And product Z, 45,000, variable cost 22,667, contribution of 22,333. So in total, I'm not going to add all the figures up, but if we just look at the contribution, we're now making £47,000 contribution just from product Y and product Z. We deduct fixed costs of 39,000 and we have a profit. Profit of £8,000 compared to originally a profit of £16,000. And the reason for this, as I hope you can see, is that our fixed costs are not going to change. So irrespective of whether we produce product X or not, in the short term, and remember this is short-term decision making, in the short term our fixed costs are still going to be £39,000. And just a reminder, fixed costs, things like the rent, rate, heat, light, insurances, salaries, they are not going to change in the short term. So therefore, by dropping product X, we are not making as much contribution towards those fixed costs, and so our profit falls. If we particularly wanted to drop product X, we'd have to think about maybe replacing it with something else. Or could we increase our sales of product Y and Z to make up for the contribution lost from product X? So this is the sort of thing that can be highlighted by using a marginal costing statement and splitting the costs between fixed and variable. We can then consider what costs are going to change depending on a decision that we might make and what costs are going to stay the same. And we will look at some more decisions over the next week or two where we can see that we base our decisions on the contributions made from our products. However, the next thing I want to look at now is a comparison of marginal costing to absorption costing. So if we have a look at our absorption costing, and just a reminder that with absorption costing we have to go through the process of allocating overheads and apportioning overheads to departments. Then we work out overhead absorption rates for each of our departments, and then we can work out the cost of our product, which is the direct material, the direct labour, direct expenses, and the overhead absorbed. So that's absorption costing. We've got the direct material, labour, expenses, and we're adding in an overhead absorbed, and that gives us our production cost or factory cost. Now, marginal costing is used for short-term decision making. When we're preparing final accounts, you have to use absorption costing. So if you're producing products, the production cost that goes into your set of accounts has to be calculated using the absorption cost, as does the valuation of any closing stock or closing inventory. So if we have a look at this layout for an absorption costing statement, you can see the basic layout you will have come across before. We have the sales revenue. Then we take away the cost of sales, and the cost of sales is always the opening stock plus production minus closing stock. Where both the production and the closing stock valuations are arrived at by using the production cost of our product. So we would arrive at those using direct material plus direct labour plus, if you did have any direct expenses, we would include those. That gives us the prime cost. Add production overhead using an OAR, and that gives us our production cost or factory cost. So we would have to use those figures to put a value to our production and to put a value to the closing stock. So we would have opening stock plus production minus closing stock. However, what you then need to remember is that in order to calculate your actual profit figure, you're going to have to make an adjustment for the over or under absorption of overheads. The overhead figure that is included in your production cost is the overhead absorbed. And you will have arrived at that by using your overhead absorption rate and multiplying it by the actual activity, whether that be labour hours, machine hours or units. That overhead absorbed is compared to the actual overheads, and the difference being either an over or under absorption has to be included in this statement in order to show the actual profit figure made. In marginal costing, I've already gone through a basic layout with you, but that one didn't have any stocks in it. So if we now look at this layout for the marginal costing, where we have put some stocks in, again we have sales revenue, and in this particular example we haven't got it broken down into individual products. So we have a sales revenue, and then we're taking away a cost of sales. Again, cost of sales is opening stock plus production minus closing stock. Opening stock plus production minus closing stock. The difference is that when we arrive at our figures for production and for closing stock, we are using the marginal cost or the variable cost. So we would be using direct material, direct labour, and any variable overheads. So you will notice there is no absorption of overheads when we're using marginal costing. So we have our sales revenue. We'll take away our cost of sales. That will give us contribution. Then we take away all of our fixed costs and we're left with a profit. So the important difference between the two is how we are dealing with the overheads. In absorption costing, we use an overhead absorption rate to absorb the overheads into the production cost, and then we have to adjust for under or over absorption. In marginal costing, we do not include our overheads in the production cost. Production consists only of the variable costs. Our overheads are all deducted as a lump sum from the contribution figure to give profit. Now this will become clearer, I hope, when we look at an example. So we're going to complete the statement using both absorption costing and marginal costing, and let's see how the overheads are dealt with. So we have a company producing a single product, and details of this product are as follow. Selling price is £15, direct materials £5, labour is £3, variable overheads are £2, fixed overheads £1. So that's per product. We're told fixed overheads are expected to total £10,000 for the period, and in that period output is expected to be 10,000 units. The business has no opening stocks, and at the end of the period fixed overheads actually totalled £10,500. And what we're going to look at doing is drawing up an absorption costing statement and a marginal costing statement under two different scenarios. The first scenario with 11,000 units being produced and sold. The second scenario, 11,000 units produced, 9,000 units sold. So we have a closing stock of 2,000 units. Before we do that, if we look back at the figures we've been given, and let's just calculate the production cost using absorption costing and the production cost using marginal costing. So we want the production cost. We're going to use absorption costing, and we're going to use marginal. So start with the direct materials, £5. Direct labour, £3. Variable overheads, £2. Fixed overheads, and remember this is absorbed. We can see we have an absorption rate, and it works out at £1. So in total, our production cost £11. Now looking at marginal costing, remember under marginal costing our production cost will be our variable cost. So we will still have the direct material because that's a variable cost. We will still have the direct labour, that is a variable cost. We will still have the variable overhead, but we will not include the fixed overhead. So our production cost when we do the marginal costing statement is going to be £10. So just have a look at that for a second. Make sure you're happy with the difference between the two, because this is going to be the main difference within the statements. Right. So here we have the absorption costing statements. The first statement, 11,000 units produced and 11,000 units sold, so no stocks. The second statement, 11,000 units produced but only 9,000 sold, so we've got 2,000 units left over, which would be our stock. So the statement starts with sales revenue. So if we look at the first statement, 11,000 units sold. Our selling price, if we just scroll back up, okay, selling price £15. And just to remind you, our production cost we've worked out at £11. So selling price £15, we've sold 11,000 units, so 11,000 times 15 gives us our sales revenue of 165,000. Then we need the cost of sales. The question told us there was no opening stock, so that's 0. Production, we're told there are 11,000 units produced, and we have just worked out our production cost is £11. So 11,000 units at £11 gives us 121,000. There is no closing stock because all the units we produced we sold. So the total of opening stock plus production minus closing stock is 121,000. So remember, this is our cost of sales. So in order to get a profit figure, we obviously need to deduct that from our sales. But the other thing that we need to do to arrive at our actual profit is to consider whether there is any under or over absorption. So what we have, our absorption rate, right, it's £2 per hour, right, which also works out at £1 per unit. So we've absorbed 11,000 units times £1 a unit. So we've got £11,000 absorbed. We were told that at the end of the period, fixed overheads actually totaled 10,500. So we have £500 over absorbed. And we add that. So £165,000 minus our cost of sales plus our over absorption gives us a profit. So I'll just let you think about that for a minute before we look at the second scenario. So scenario number 2, we have still produced 11,000 units, but we've only sold 9,000. So our sales revenue is based on 9,000 units, which we sold for £15 each. So that's where the 135,000 comes from. Then we move to our cost of sales calculation again. No opening stock. Production. Remember, we produced 11,000 units. So our production, 11,000 units at £11 a unit. Remember, we're still doing absorption costing, and our production cost under absorption costing is £11 a unit, this figure we've worked out here. So 11,000 units at £11 gives us 121,000, the same as before. But we didn't sell all of those units, we only sold 9,000 of them. So we've got 2,000 units left, so that's our closing stock. 2,000 units, also valued at our production cost of £11. So opening stock 0 plus production minus closing stock. The overabsorption figure will be the same as it was when we produced and sold 11,000 units, because remember, the absorption is linked to the production. It's £1 for each unit produced, and we've still produced 11,000 units. So looking at the final figures, we have the sales revenue minus £99,000, add on our overabsorption, gives us a profit figure of £36,500. So that's our two statements using absorption costing. The first example without a closing stock, the second example with a closing stock. Now we need to repeat it again using the marginal costing format. So just a reminder, let's go back to our original workings. The production cost with marginal costing, £10 a unit. So that's what we're going to use when we do the marginal costing format. So if we have a look at this one. So firstly, 11,000 units produced, 11,000 units sold. So our sales revenue, 11,000 units at £15 a unit. So we've got the same sales revenue as before. Then we have cost of sales. Opening stock is 0. Production, we have produced 11,000 units, but because we're doing marginal costing, our production cost is £10. So that's 110,000. We have no closing stock. So sales revenue, oops, don't want that. Sales revenue minus our cost of sales gives us, you can see we now have the term contribution, because this cost of sales is made up purely of our variable costs. Sales minus your cost of sales gives us a contribution. Total contribution minus the fixed costs gives us the profit. Fixed cost deducted as a period cost, and what we need to deduct is the actual figure, because remember we're doing marginal costing, so we don't think at all about what we might have absorbed. That is not relevant. All we want is what was our fixed cost for the period. Well, we were told they were £10,500. So contribution minus fixed cost, we've got a profit of £44,500. Let's just scroll back up. Under absorption costing, profit £44,500. So different layout, same profit figure. Now we look at 11,000 units produced, 9,000 units sold. So sales revenue, 9,000 at £15, gives us 135,000. Then we need our cost of sales. Opening stock is 0. Production, well, we produced 11,000 units, and production cost, because it's marginal costing, is £10. So that's 110,000. But this time we have a closing stock. 2,000 units were not sold. We value our closing stock at the production cost, which is £10. Gives us a closing stock valuation of £20,000. So opening stock 0 plus 110 minus 20 gives us our cost of sales of £90,000. Sales minus cost of sales gives us contribution. Contribution minus fixed costs gives us profit. So we have £34,500 profit. Scroll back up. Under absorption costing, we had 36,500 profit. So we've got different profit figures. So absorption, 36,500. Marginal, 34,500. So the difference in the profits is £2,000. Same number of units produced, same number of units sold, but we've got a different profit figure. Now if you have a look at each of them, we have 135,000 sales revenue, 121,000 production, 22,000 closing stock. $135,000 sales, 110,000 in production, 20,000 in closing stock. So our closing stock figure is higher with absorption costing than it is with marginal costing, and it is higher by £2,000. So that difference in profit is due to the valuation of the closing stock. In absorption costing, our closing stock is valued at a higher figure because it includes some of the overheads, whereas in marginal costing, our closing stock is valued purely at the marginal or the variable cost. We do not include any overheads. So that's the reason for the difference. So that's the two methods compared. So you've had an introduction to what marginal costing is, what it is used for, which is short-term decision making, and we've looked at how we can prepare marginal costing statements. We've then compared those marginal costing statements to absorption costing statements, and we've looked at where there are differences in the profits, which only occur when we have closing stocks, and we've identified the reasons for those differences. So we have covered quite a lot within this recording, so I hope it's been useful to you and that you'll now be able to apply this to some questions and scenarios. Okay, thank you for listening.